Hi, and welcome to my monthly Market Insights video. My name is Dan Timotich. I'm a managing principal and portfolio manager at T2 Asset Management. Before we get started, just a reminder, this video is for educational purposes only. The opinions expressed in this video are mine and do not reflect the opinions of other portfolio managers. You should always consult with a financial advisor before making any investment decisions. Investments involve risk and are not guaranteed. August was quite interesting. In particular, the last couple of weeks have been exceptionally interesting. Each day we've been hearing about a recession, and it's really starting to scare the market. Clearly, there are a lot of people hoping for a recession. Obviously, from a political perspective, the candidates for the Democratic nomination are hoping for one since they think it'll help them politically. There's been a lot of liberal commentators that have said openly that a recession would be great for the Democrat Party in 2020, and all of this is understandable as far as from a political perspective. However, when you have Bill Dudley, the recently retired New York Fed president, come out and say that the Fed should do whatever it can to make sure President Trump doesn't get reelected, that is, and I quote, grossly irresponsible. And that's what Larry Summers, the former Treasury Secretary under Bill Clinton, said about Dudley's op-ed. Look, Dudley is basically just telling the Fed to push us into a recession just so Trump doesn't win in 2020. You got to really think about this for a minute. A former voting member of the Fed would rather see a recession than a Trump second term. In other words, the millions of jobs that would be lost in a recession is really not that important as long as Trump doesn't get reelected. If you still think that the Fed is an objective, independent, apolitical agency, you may want to rethink it. I'm sure that Dudley still has some friends at the Fed with similar feelings. I just hope that the voting members at the Fed are a little more sane and do the right thing for the economy and for the country. So let's address the idea of a recession. Let me be clear. We are not in a recession, and I do not believe we are about to go into one in the foreseeable future. We will eventually get into a recession, but not now. I know a lot of people have been talking about the inverted yield curve, and I'm going to address that in the next few slides. But one data point really doesn't make a trend. Our economy is growing. We just got second quarter GDP numbers showing a 2% growth rate. That's far from a contraction. Employment numbers are great. The consumer is in better shape now than they have been in years, and since the consumer makes up about 70% of GDP, this is a great sign. Financial conditions are still quite accommodative. And finally, credit spreads are still on the tighter side, indicating very little concern about defaults. Given all of this, I just don't understand how people can seriously think we're about to go into a recession. Yes, we have ongoing trade issues with China, and that's disruptive, but I'm going to be addressing a lot of the trade issues next month in more detail. But you do have to remember something. When tariffs were put in place over a year ago, all the so-called experts said that the tariffs would hit the U.S. consumer, hurt profitability, etc. Well, none of that happened. It clearly shows that there are many people that have a vested interest in the status quo, so you just have to weigh that against what's really going on. Let's talk about the inverted yield curve for a little bit. When the yield curve first inverted in August, I think it was August 14th, it lasted for all of about 2 minutes and went right back to positive by the end of the day. Given the news coverage, you would have thought that we were basically in 2008 all over again. When the yield curve inverts, it's not like a switch that says a recession is imminent. It needs to stay inverted for quite some time before you can really draw any sort of conclusions. Here we have a monthly chart showing the spread between the 2-year and 10-year Treasury yields. Looking back to the last recession, we can see that the yield curve inverted in 2006 for about 2 months, basically in January and February. Then it reverted back to positive until about June, and then it went inverted again. The yield curve stayed inverted during that period from June 2006 until about March or April of 2007, and we didn't get the recession until December of 2007. So when the yield curve inverts and stays inverted for several months, it is indicative of a recession and that a recession is likely. But the last time that happened, it was still about 18 to 24 months after that inversion. So it'd be a little bit premature to think that a recession is just around the corner here today. Now, if the yield curve is, if it was the only thing that we really needed to look at to know if recession is coming, I think life would be pretty easy on our side, but it is only one factor. Here we have a chart of the unemployment rate, and the shaded areas here are recessions. This, in my opinion, is much more important than just looking at the yield curve. You cannot have a recession if employment is strong and growing, and honestly, it's really that simple. In 2007, we saw the monthly unemployment rate rise above its 3-year average at about the same time that the recession started, showing that jobs were being lost. Today, as you can see here, we're a long way from this happening, and is another reason why I don't believe we'll see a recession anytime soon. And just one more factor to consider is credit spreads. Here we have the spread of high yield bonds over the treasury rate. And as you can see here, you really need high yield spreads to get above 800 basis points before real concerns start to appear. Why? Spreads widen out when there's concern over increasing defaults. Defaults increase when the economy is weakening and profit margins start to contract. Clearly, we don't have those concerns today. Defaults are extremely low, and companies are not having any trouble accessing the debt markets. So, if the economy is good, credit is abundant, employment is strong, why did the yield curve invert? I think it's a couple of things. The Fed rate hikes, as well as global interest rates. We already know that the Fed went too far, so let's just focus on what's going on in the global interest rate market. Here we have a chart of the 4 major bond markets in the world and the yield on their 10-year debt. The top black line is the United States, the red line is Germany, the blue line is Japan, and the green line is the UK. Considering how strong the U.S. economy is relative to the rest of the world, why would anybody be interested in investing in Germany, where the yield is negative? Clearly, money is going into the U.S. Treasuries, and this is causing the yield to drop below where the fundamentals should put it. In other words, the demand for Treasuries is so strong that the yield has fallen well below where the real yield should be. As a side note, Japan is now the largest non-U.S. holder of Treasuries. Not a bad investment for them, considering their 10-year is yielding about negative 25 basis points. Look, folks, these are the unintended consequences of negative interest rate policies by central banks around the world. Because of the actions of these central banks, our yield curve has been distorted, and you need to consider that before making any investment decisions. So with the 2-year anchored by what the Fed does and the 10-year being influenced by global demand for higher yielding debt, the yield curve has inverted, albeit for a short period of time. Does this inversion carry the same weight as it has in the past? I don't think so. You shouldn't dismiss it, don't get me wrong, but you shouldn't put a lot of stock in it either, at least not in the near term. Another point of the yield curve, even the 30-year Treasury yield is now at the lowest level ever. You have to ask yourself a question. Do you really think that things are worse today than they were in 2008? The dividend yield right now of the S&P 500 index is higher than that of the 30-year Treasury. Last time that happened was March 2009. Now, I'm not saying that we can expect a similar type of rally, but it is something that's worth pointing out about how distorted the interest rate environment has become. Okay, let's just jump in and see what happened in August. Everything can really be summed up here by the Treasury market. Long-term Treasuries were the best performing asset class for the month, and they are on fire for the year. They're up over 22%. While stocks are doing well, they did have some trouble in August, and small caps in particular are lagging the larger cap counterparts. Turning to sectors, we see a similar story. Defensive sectors like utilities are performing extremely well, but energy and healthcare, they continue to struggle, and they're barely positive for the year. Turning to fundamentals in my 4-part framework, these are 4 major components that I look at when making investment decisions over both the short term as well as the long term. So let's take a look at each of these independently. As far as the economy is concerned, I'm somewhere between neutral and positive. GDP is strong, employment is strong, inflation is low, but I am worried about the Fed. Is Chairman Powell going to listen to Bill Dudley and do whatever it takes to ensure Trump doesn't get reelected, or is he going to do what's right for the economy? I'm really unsure. So you just need to be a little bit cautious here. Looking at earnings, Second quarter was good. 75% of the companies reported actual earnings per share above estimates, and the reported earnings were just about 6% above their estimates. Revenue was a bit on the softer side at about 4%, but all in all, not a horrible quarter. Valuations, they have gotten a bit better with some of the sell-off that happened in August, but the forward PE ratio is still above the 5 and 10-year average. With the forward PE of about 16.5, I don't think the market is overvalued. I think it's probably fair. I even took the opportunity to add some stock exposure when the market sold off in mid-August. And finally, the markets are going to continue to be on this roller coaster ride. It's clear that the algos and computer trading are driving volatility. Just look what happened with one little tweet. When one little tweet is sent just about trade with China, the pendulum just completely swung from greed to fear, and I think the pendulum is going to continue to swing back and forth as program trading continues to pick up some of these things from time to time. And I'd caution investors not to try to time these swings. Obviously the computers are a lot faster than you, so you just can't react in time. Okay, so where do we go from here? I think data matters. If you're simply listening to some of these pundits and not doing your own research, you're going to be in for some real surprises. Obviously, it's pretty obvious, I think, at least, that the market is going to force the Fed to cut rates here again in September, whether they want to or not. After that, I think it's going to be data is going to become much more important, so we need to really pay attention to what's being printed. Because of these high-frequency traders, investors they need to understand that large market moves will continue, and you shouldn't overreact to the upside or to the downside. This is where process and discipline makes a huge difference. Last month, I said that there would be better opportunities to add risk, and we certainly got a few pullbacks in August that allowed us to add some exposure. If you overreacted in August, you very well could have been whipsawed, and that's not a very good place to be. I'd stop listening to these pundits. Earlier I told you that many of these people have agendas that are politically motivated, and they're going to say whatever they need to. A lot of what they say will be picked up by the media, and before you know it, you're going to think that we're in another Great Depression or something. And unfortunately, we are now in a market that's going to require us to be much more active and rotate positions a little more often than I would normally like. I've said it before, and I think it still holds true. The market is never as bad as it seems when it falls hard, and it is never as strong as it seems when it's hitting new highs. So I think being nimble is a good thing. It's going to be very helpful, I think, in the coming months and in the coming quarters. Thank you all for watching. I hope this video was helpful, and if you have any questions on anything in this video or just want more information, please don't hesitate to call or email me. Thanks again, and I hope to see you next month.